you very much. I'd like to call to order the special meeting of the uh, KRS Investment Committee on September the 11th. We did not have an agenda at our previous investment committee meeting, and therefore one item of importance to our investment staff and to our system did not get considered. Do we have an opening legal statement?
Yes, sir. This is a special called meeting of the Kentucky Retirement Systems Investment Committee. This meeting is being broadcast via video teleconference pursuant to Kentucky Revised Statute Section 61.826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road, Frankfort, Kentucky. It is also being broadcast to the public via Facebook. If you are speaking and not appearing by video, please identify yourself before talking. Please ensure that you are on camera when making or seconding a motion or casting a vote. In the event the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to another date.
Thank you. And could we have a roll call
Yes. Mr. Lane,
here?
Mr. Atkins,
Here.
Miss Bova,
Here.
Miss Thompson. That's all for roll call.
Thank you. And that three gives us a full meeting, as I understand it, and understand that we have no public comment.
That's correct.
And the approval of the minutes, I guess, because our meeting and the previous meeting, we did not do approval because so we have the May 22nd approval of minutes, which have been distributed. Any comments or corrections or that anyone has for those meetings, for that meeting?
Move approval.
And I will second that. So, that means I think we have approval of that. We do need to vote. So let's vote. All those in favor, say aye.
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 Opposed? Thank you. The minutes pass as presented. And the item that is on our agenda today that is of importance is recommendation from staff for a private equity investment, which is not necessarily new, but is one that we do need to approve to add to. And I'll let Stephen take it from here.
Thank you, Pruitt, and thank you, everyone. Appreciate your time today, especially for a special called meeting. One page forward, please, Sandy. Thank you. As we've discussed at committee and board meetings over the past few years, staff has maintained what we would call a structural underweight to the private equity asset class. And that's primarily as we view the risk reward propositions offered in competing asset classes as better investment opportunities for the funds. Following an extended period where there was an abundance of cheap financing available for deals, the private equity market has faced a challenging environment with mounting headwinds and shifting economic landscape. Especially with higher interest rates have negatively impacted the buyout math and valuation multiples, making exits more challenging, which is really evident in the marked decrease in deal activity and the significant decline in realizations and return of capital to investors. Last year, private equity fundraising was at a 7-year low, and distributions were at the lowest level since 2009. These headwinds have resulted in subdued returns, which have often trailed public market alternatives. So maintaining that structural short has been beneficial to the portfolios. And while we don't believe the current market opportunity for private equity has materially improved, especially as rates continue to be elevated and they face liquidity issues, we do believe the unique differentiated strategy of the Strategic Value Special Situations Fund 6 presents a compelling opportunity and a strategy within a market space that should provide attractive opportunities over what we see as the coming market cycle. And this is with a manager that has a proven track record of execution, who has been managing money for the systems for almost 10 years. So with that introduction, I'll turn it over to Anthony to cover in detail and answer any questions.
Thank you. Yeah, we can go to the next page. Just to elaborate a little bit on what Steve was saying, you can see the return process, the prospective returns, even if, from Wilshire's perspective, on the bottom left, 5 years ago at middle of 2020 versus middle of 2025, you can see with the interest rate increase, obviously things like fixed income and cash have become higher expected return. Private equity has actually decreased a little bit now that rates are higher, so multiples are down and it costs more to do these deals. So I think we've always had some concern about valuations and just the amount of capital in the space, and then these dynamics don't help. So that kind of speaks to the slide that Steve was talking about. We can go to the next couple pages, or next page, please. Sorry. So this is private equity today. This highlights the KRS pension. So this plan and the SPRS pension plan, especially, are kind of unique because they didn't do any private equity commitments from 2011 to 2021 because of the liquidity concerns that we had and the underfundedness. So I think they probably benefited to some degree from missing some of those vintages that are having a tough time exiting are still around, honestly. So it's been underway. We've had some of the allocation to proxy as we wait for some things that we think are attractive, such as this recommendation. You can see on the top right, Bay Hills, which is a fund of funds and that we had some litigation with that's now settled, is still a significant portion of the portfolio because those commitments were done in 2007 and 2009. So and a lot of those some of those are still around. So we go to the next page. So similarly, you can see on the right side chart, the big yellow wedge, that's a lot of the stuff that's pre-2010 that the KRS pension plan did. And so a lot of it's buyout. There's still some legacy venture, which you can see in the gray pie on the top left, or on the left. And so that's kind of how this portfolio looks. We can go to the next page. The pension the plan of K's that on the pension side that did continue to allocate to private equity throughout was the KRS hazardous. So you can see there's quite a few more managers here since they continue to allocate during the 2010s. And we can go to the next page after that. So you can still see it's quite a few assets that are over 10 years old. That's just again because we have done less private equity since I've been here basically. And so that's kind of why a lot of those are still continuing to be around. And we can go to the next page after that. This is the state police pension, so similar to the KRS pension. This didn't do any commitments for 10 years or so. So again, we have a lot of exposure in Bay Hills, and then some exposures and some newer managers like Strategic Value Partners and Middle Ground, which we did in 2021, and that both the KRS and SPRS pension plans did participate. So, but again, those two plans particularly have the lower expected return, and so it's the allocation to private equity has been lower anyway. But those were very under, so those have received some of the private equity allocation from the last time we did this. All right, the next page is again the fund age. Again, quite a large wedge for the 15+ years. With this kind of recommendation, hopefully we'll be changing some of that to newer commitments. The next page, please. So you guys have seen this slide before. As you guys probably know, private markets aren't like public markets. You can, but you probably don't want to just do a search to find a buyout manager or venture manager. It's something that you ideally would do over time, kind of continuously, in terms of looking at the market, seeing what's in the market, who's doing what, people moving around to different firms, starting firms, who's raising, growing, things like that. So it's a kind of an ongoing process to see what's interesting and attractive for your plan and what you're solving for. So we'll go to the next page after that. These are just a couple of strategies that tend to be, the broader strategies in private markets that tend to be considered. Buyouts is probably the one you've heard of. They're normal private equity, using debt to buy companies, 50, 60, 70%, and then hoping that the cash flows of the company can pay that debt down, which increases equity value. Maybe if you increase the EBITDA and multiples, then you make a lot of money. Of course, valuation multiples have continued to be high. Like you can see in the top on the bottom left chart in the purple and blue, you're still just averaging around 11 or 12 times EBITDA. The right side chart is from Hamilton Lane. You can see how things have changed since 2007 and just a couple of years ago. The dynamics have been less good on all this in terms of higher leverage, higher multiples, things like that. We go to the next page, please. Secondaries is an interesting strategy that people talk about a lot, especially since it's growing every year in terms of volume. And this year, you've seen the Ivy League schools, some of them who are a little bit on the more liquid side, needing liquidity, having to sell some of their portfolios. So as a concept, it's interesting because buying things at a discount, could present some value. Of course, it depends on whether those values are, what they say they are. And then also, there's quite a lot of capital chasing this as well, as you can see. The left side chart just talks about the overhang of funds that have been raised, so dry powder, versus the volume that happens in 12 months. So I think what it shows you there is as of middle of 2025, they've got a year and a half's worth of capital to deploy into this. So that's even with more and more people coming to market, like in the headlines. So and the right side chart, you can see the pricing for a lot of these on the average are not super high discounts. And this is going to be usually newer vintages and things like that. There's been talk about us cleaning up some of our portfolios, especially with those 15+ year things. I would say there's not a lot of demand for those kind of tail end assets, especially they're very small. Most people would probably just value maybe the one or two significant companies in a fund, and the rest would just be zero value for options. So. And I think the last thing I'd highlight is the bullets under the chart on the right talk about just the mega funds that have been raised. So you're talking $30 billion, $20 billion funds. So they're basically having to, there's a lot of competition to deploy. And so that usually does not result in necessarily good pricing. Okay, maybe the next page after that, please. And this is venture. I think the risks here are a little more binary for companies. That's just kind of how. That's just the game that is. And also the size of the market is just much smaller. So it's gonna be hard for us to put enough money to work to matter here. So we historically haven't done a lot here. Okay, can we go to the next page, please? So as Pruitt said, our recommendation now is to commit some capital to Strategic Value Partners Fund 6. We have done Fund 4 and Fund 5 for the K plans. You can see as well as a toll road continuation vehicle last year in Texas. So those are the investments in the chart in the middle of the page. As you can see, I think for Fund 4, we didn't do as much in the Ks. I think only hazardous and the insurance side were committed because again, the police and the KRS pensions were not committing at that time. They did participate in Fund 5, which was in 2021, and the toll road last year. So, all right. And then I'm happy to take any questions if you want. Their strategy mainly is to buy debt in companies that are stressed, and then if they are able to take them, they usually source debt directly through banks, who's usually the holders of that, especially in Europe. So historically, their portfolio has been around half U.S., half Europe, and through their direct sourcing, they're able to sometimes take control of the companies, and then they also have an operations team that comes in to help improve those. And since our last fund, they've done that successfully in a couple of companies that were impacted by COVID. So one was Swissport, which services a lot of airports that many of you all were discussing earlier about international travel. They're the ones who check you in, do the baggage, things like that. Obviously in 2020, that was difficult for them, but that allowed a lot of distressed players actually to participate in that bankruptcy. But SVP was able to source enough debt to be the controlling shareholder there. And so that has been it's been a successful investment, as well as they also took over a bankrupt mall REIT, which was also impacted by COVID, as well as some interesting investment decisions by the previous management that they have rectified, and that is a significant profit. I think the most profitable investment in their history, and so that's been being liquidated, and we've been receiving capital from that back this year and last year. So other than that, I'm happy to take any other questions you guys might have.
Yeah, and I would just add, as Anthony mentioned, so across the systems, we have investments in Fund 4 and Fund 5. And Fund 4, both of those funds have done very well for the systems. 4 is in harvest, so it's returning capital And 5, I believe, still has a very short tail end of the investment period. Is that correct, Anthony? They're nearing
right.
completion of the investment period, so they'll enter
That's right,
harvest
early
soon
next
as well.
year. Yep, early next year.
So does anyone have any questions of either Anthony or Stephen on this new but addition, if you want to call it that, investment into the private equity area?
I just have one question. So,
Mhm.
and you may have just said this, so I apologize. So the existing investments that we have
Mhm.
we, with this company, have we ever gotten out of one? Have we gotten out of one yet? Like
The
liquidated it?
funds, oh, they're not fully liquidated. No, so you can see on the let's see, page 22. In the blue, the NAV is the NAV 113 for SPSS 4, 34, and 32. So there's about 78 million of market value for the K plans. Still left, but like Steve said, we have been receiving money back this year. I think this month the last month we got money back for Fund 4 for LATAM, which is the airline. They had some of the aircraft that was leased to them, as well as some of the equity as they went restructured. So we got back about $4 million last month on that one, and then another 4 or 5 million back from that, as well as the Swissport that I mentioned that does the airport services, and the Washington Prime, that's the real estate mall real estate investment trust. They've been selling off the closed air malls or the enclosed malls assets that they have. So we've been getting
So
back actually.
my question is, when the money comes back, does it
Mhm.
just go into like our general fund? It's no longer with them.
Right, it's cash. It comes back to cash. Mhm.
Got it. That answers my question. Thank you.
Yep.
I mean, it's always a good question when you have an existing manager to understand what the return, not just the returns, but the nature of the returns.
Mhm.
Because we have done some continuation vehicles and
That's right.
with a few of our managers, and
Mhm.
that's a little bit of a trend that's taking place in the industry.
Mhm.
When a continuation vehicle looks attractive, we want to be in it. If it's just because they can't get out of their investments, we don't want to be in that.
Okay.
So and this is not that case. This is a new fund. Is that right, Anthony?
Yeah, they've been deploying quite a bit. I mean, distress, I think some people view it as a trade. I think Strategic Value Partners, you can see their record. They've deployed throughout different environments, even ones that are, let's say, less stressed, and still found successful investments. I think they throttled the pace back a little bit the past couple of years, and then there's been more distress in 24 and this year. And I think they're on a $4 billion per year deployment pace. So, I mean, they're raising a $6.5 billion fund. So they could deploy it quickly. They've also returned, I think, they returned more than 4 billion last year. So across their funds, so it's not something that's just taking in money and then not returning it back. They've been monetizing investments as well. But yeah.
And Anthony, this investment, would it impact the allocation criteria? Does it take it out of range in any respect?
No, I mean, it gets us a little closer to target for private equity because I think when asset allocation was done, we have the targets were reduced a little bit. Let's see, where's that chart? That's on page. You can see on page 10, please. So you can see on the right side, those are historically the target allocations. So the hazardous pension and the insurance ones, which are the higher rate of return ones, plans, they had a 10% target for a while. The last time we did that asset allocation study, it was reduced to 8. I think, and that's partially because there was a hand on the scale. I think, given those prospective returns you saw on the next page from Wilshire, without a floor of equity, they would have been 0 in some cases, because private credit and fixed income were so attractive, and given our goals for 5.25 and 6.25, we didn't really need to take that risk, and there wasn't that much return for that. So the optimizer, actually suggests 0 for private equity for several of the allocations, and I think closer to that for public equity as well. But that's a little bit bigger swing than I think anybody wanted to do. So, but that I think speaks to how in terms of when you balance it against the rest of the portfolio, it just was not as interesting, but this will get us a little closer to target. The recommended 75 basis points for each plan.
Yeah, and specifically, as Anthony mentioned earlier, we are managing proxies, so liquid security proxy positions for some of that underweight in the private equity portfolio, and it would be anticipated as capital is called for a new investment, we would wind down the existing proxies.
And remind me I failed to bring my draft motions with me, but the amount that we're targeting.
Sure, it'd be for 75 million across the KNS plans.
Thank you. So I think if there are no more questions, I think we've had a good explanation of what we're trying to do here. And so I will seek a motion to add 75 million to our SVP, a new fund position.
And Mr. Chair, just to be clear, is this a recommendation to the full board, or is this something we have the authority to act on exclusively?
We will be approving it, and then the full board, if legal will correct me if I'm wrong, will ratify it.
Okay.
Correct. That's the way the policies are written right now.
Yeah. So I would move that we accept the recommendation of staff as offered and recommend to the full board adoption of this change.
I'll second.
Okay, we have a motion on the table and a second. And I think on these new these types of allocations, we should do a roll call. So could we have a roll call? Okay, I'll do a roll call.
No, I've got it. I'm sorry. Mr. Lane,
Yes.
Mr. Atkins,
Yes.
Miss Bova.
Yes.
Thank you
And
very much.
that's it.
The motion is unanimous, and appreciate everyone's attendance on this. And I guess we have a full blown meeting coming up in a few minutes, and we'll find ourselves in that as well. So thank you very much.
Thank you.
And the ever popular motion to adjourn. We'll sort of waive that and assume that is unanimous as well.
Yeah. See you soon.
Thank you very much.
Thank you.
Thank you.